Hello and welcome to UCI Beal Applied Innovations VC Speaker Series, our webinar featuring conversations with VCs and investors. Our goal for this webinar series is to continue to connect the Southern California innovation ecosystem with the experts and the resources that will help entrepreneurs and founders navigate the current challenges and thrive in the recovery that we're expecting in 2021. For today's webinar, we're pleased to have with us Anderee Berengian, founder and managing partner of RezVen, and he's also the founder and CEO of C. So before we get started, though, I want to make sure that I acknowledge and thank our sponsor for the VC Speaker Series, Kenobi Martins. They're consistently ranked as one of the top intellectual property firms in the nation and worldwide. Kenobi Martins has close to 275 lawyers and scientists and dedicates its practice to all aspects of intellectual property and technology law, including litigation. The firm is headquartered in Orange County. We're very fortunate at UCI Beal Applied Innovation to have Kenobi as strong supporters of our mission and of this VC Speaker Series. More information can be found at www.kenobi.com. So a few details about today's webinar. So unlike regular Zoom meetings, you can't unmute yourself and you can't turn on your video. So if you have questions, please use the Q&A box that you'll see, not the chat box. So I'll moderate and ask questions that we get throughout our discussion, or we'll get to them. And after our discussion portion of the webinar ends, we'll keep the Zoom webinar open so Anderee and I can type in some answers into the Q&A box. So if your question doesn't get asked and answered live, we'll keep an eye on the Q&A box. And after we wrap up, we may be able to put it on there. So with that, I think I want to welcome Anderee. If you want to turn on your video and join us. There you are. How are you, man?
I'm pretty good. How are you?
Good, good. Good to see you. I'm excited about today's conversation. It should be a lot of fun.
Me too.
Okay, good. So listen, before we get started, I'd like our audience to kind of know you a little bit more. So tell us a little bit about your background. Where were you born? Where'd you grow up, etc.?
I was born overseas. I was born in Iran a long time ago, and my dad actually is an engineer. So he was wanted to come to the U.S. to study engineering. So he was a grad student at University of Michigan. So we ended up in Michigan in the Midwest. I grew up there through elementary school and then middle school in Ohio in Cincinnati, and then ultimately came to California, to Orange County. Did high school here and then kind of stayed in Southern Cal.
Oh, okay. So you did high school here. Where was your high school?
In Huntington Beach, high school called Edison.
Oh, okay. You're from Edison. Terrific. Used to have a good football team. I don't know about anymore, but
yeah, back when I was there.
Okay, excellent. So, and then you went to school at UCLA and USC, so definitely kind of stayed local. So, what did you study at those schools, and kind of what motivated you to get into the fields that you ended up studying?
Sure. So I for the longest time I wanted to do good, and for whatever reason, my definition of doing good was doing it through medicine. And so, what I wanted to do is I was a biochem undergrad. I was thinking of becoming a doctor, did a bunch of work in the hospital, and I realized a couple of things. Number one was that I had a slight bit of germophobia to me. So being a doctor is not a good thing if you're germaphobe. The second thing was that I always wanted to do things at scale. And I realized really early on that as a doctor, you can't really do things at scale. Maybe you'd see 10 or 12 patients a day, but to me, that wasn't really scale. So I switched from going into the MD world into doing research. And so I was doing a biophysics PhD looking at molecular structure. So basically how things work at a molecular level, specifically focused on estrogen targeted carcinoma. So focused on women's cancers. And so I did that research. And then I spent some time doing molecular structure over at Amgen. And what I loved about that was being cutting edge. Nobody had done the things that I was doing. What I didn't like about it is the 20+ year cycle to get to a drug that you could bring on the market.
Good point. Good point. Yeah. So that would take a while. It's interesting. You brought something up that I heard another pretty prolific founder say the same thing, that early on they discovered that they wanted to do things that scaled. So yeah. that's a great insight for someone to have kind of at a young age. What prompted that? What made you think about that instead of just kind of doing good as a doctor or as a researcher?
You know, I saw when I was super young, I saw a lot of suffering in a lot of different ways. And so for whatever reason, I just thought, wouldn't it be interesting to, whatever I end up doing with my life, basically be able to affect or help a lot of folks. And initially I thought I should know them one-on-one, and that's why I was doing the doctor thing. And then I realized down the road that I don't need to necessarily know if I can just have high impact. And so I don't know, it was just somewhere in my DNA. It was just kind of an innate thing that I needed, I had a desire to do.
No, that's interesting. I think someday someone will figure that out a little bit closer. So, so you were definitely you were doing some research or doing scientific work at Amgen, and then you made the jump over into technology, and then you kind of had an interesting career. So let's talk about your career kind of in the technology area and one company in particular.
Yeah. So I ended up at a little company called Overture. And so Overture pioneered paid for placement, click advertising. So, when you Google something, the stuff that shows up at the top that says paid advertising, we pioneered that space about 20 years ago now, believe it or not. And
yeah.
So what was really interesting about that business to me was a new way of kind of reimagining things that already exist. Paid advertising, print advertising, but now doing it online. The second thing that was super interesting to me was it was a place where I could go to offer something that I knew. And so when I was doing research, I basically analyzed massive data sets. And so I could offer that because I wasn't a business person, I was a researcher. And I say, look, but I can analyze or, work on numbers. And then I could learn back basically, kind of this whole new trend in online. And so that was kind of the start of doing startups for me.
Okay. And listen, Overture definitely had a very interesting history. Yeah. And I think as you and I were talking, I think I'm the one that brought it up that, I think Overture and what it ended up doing probably had a greater impact on the Southern California entrepreneurial ecosystem than almost any other transaction. You can argue that maybe kind of MySpace and some early social media investor, folks in Santa Monica had a lot, but why don't you tell everybody here kind of what eventually happened to Overture and kind of how that affected the Southern California ecosystem?
Yeah, so I call it, or a lot of us call it the Overture Mafia. You've heard of probably PayPal Mafia, a lot of mafias out there, but I think a lot of my colleagues, a lot of the folks where we were kind of working shoulder to shoulder, building this amazing business and really reimagining advertising, they all had this deep desire to do something cutting edge and to do something at scale. And so what ended up happening in just, I don't know, it was like 5-6 years, short period of time, Overture grew, went public, and then ultimately was acquired by Yahoo. It was around $2 billion, acquisition. And then a lot of the folks that were there, if you think about that period of time, it's extremely, extremely intense to build a business to that kind of scale in a short period of time. And so everyone has tremendous experience doing lots of things, whether it's, growing in the US, international, scaling product. And so everyone had that desire to continue doing that. And so the great bulk of our folks, my colleagues, executives, all went out to start new things or run businesses that you've heard of. And so I'll tell you, there's probably 1 or 2 or 5 Overture people at every company in Southern Cal. Many of them are the ones that we read about, cool startups.
Yeah, so it's fascinating too that I don't think a lot of people know that AdSense and kind of what they started or kind of also started here in Southern California, and that's created another whole aspect. So Southern California certainly in has some of the foundational technology that really kind of enables all the business models or many business models in internet and internet search right now. So, okay, so you rode, you kind of helped grow Overture through it becoming public, and were you there through the acquisition from Yahoo as well? Okay.
Yeah, in a little while after the acquisition, and what I realized as part of that is Yahoo had we had a few products. Yahoo had hundreds of products. We had, I think at the time of acquisition, maybe like 15 or 1,800 employees. Yahoo had like 35,000, and so what I realized that kind of scaling and growing this thing and ultimately getting it to its next home was amazing. But I'm not a big company guy. I'd rather really get my hands dirty and do a lot of things and wear a lot of hats. And so post acquisition, I stayed on for a little while, and then I kind of moved on to my new chapter of startup land.
Okay. So other than not wanting to, kind of be a big company guy, what were some of the other motivations for you to kind of move on? And I think at that point when you started RezVen, is that right?
Yeah.
Okay.
Yeah, I think the motivation for me is I really enjoyed seeing kind of the action reaction. You do something and then you can measure and see what happens. It's like startups are a lot more real time. You put a signal in and then you can see something happen pretty quickly. With the large companies, I felt like we had, a meeting about another meeting, and it just kind of wore on me. The genesis of RezVen was really simple. Throughout the process at Overture and before, I really had this fascination with, building things that had meaningful impact. And I was just trying to learn and understand it. What I thought one of the key things, the key elements of investing wasn't just to provide capital. You guys can see today, there's a lot of capital floating around. I really thought it was being able to provide impactful hands-on help. And so what I did is I pulled together some of my friends and colleagues who had in their own right started and scaled and exited companies. And then what I did is took those folks and said, all right, why don't we pool together some capital, and why don't we pool together our expertise and experience, and let's figure out how to invest in things where we can add value. And the value add isn't going there day to day and operating, but it's providing a lot of experience from all of our mistakes to make sure that those mistakes aren't repeated. What does that mean? Faster time to market, more capital efficiency, less dilution, faster time to success.
Okay, so about how many folks were involved in RezVen Partners kind of in the early days? Was it
in the early days?
Was it classic kind of managing directors and LPs, or were you guys kind of more? Was it more kind of a group collaborative model?
Yeah, so in the early days, the MDs and the LPs were kind of the same.
Okay.
It was just basically we're putting in a couple bucks of capital, and then we're going to help. And then over the course of time, there was LPs that were not necessarily, the MDs or the GPs. And so what my vision was is, all right, what are some of the key areas where people need help? Well, probably technology, architecting, marketing, sales, accounting, finance. And so I tried to find friends that were the expert in each of those areas, and also had an interest in investing, and say, hey, let's put our heads together and see how we could ultimately not only invest, but also help. And that's kind of how the genesis of that. And the idea was never to do it full time. It was just to do it in an active way, but not necessarily full time.
Okay, gotcha. So not necessarily building a permanent structure of a firm, but doing it opportunistically as you see those. Okay. What were some of those, what are some of the early investments at RezVen? Anything you can share there?
Oh gosh, now I gotta dust off the brain here. So we had one company, Style Hall. Style Hall was the largest fashion and beauty multi-channel network. And that company scaled from zero to sale in about 3.5 years. So we led the Series A for that business, and in addition, we helped with a whole host of ideation around technology to ultimately create scale. So Style Hall basically managed a bunch of influencers and had a lot of content. At peak, 5 billion views of content a month, 300 million subscribers, and over 100,000 content creators. Needed a whole lot of technology to manage that. So that company interestingly went from zero to sale to 3.5 years. $305 million exit.
Nice.
Yeah, and then there's a whole host of others, but that's kind of one that comes to mind.
Okay, what are some of the you're an operating guy. You're helping build. You help build Overture, Yahoo. Kind of learning that you gather some other operating people, but now you're making investments. Now you're kind of literally putting your money where your mouth is. What are some lessons that you learned? What was kind of different about being an investor and an operator as opposed to just an operator?
I had a lot of lessons learned. One is just because you're a good operator doesn't mean you're a good investor.
Yeah. They're
different skill sets.
Time to rip up some PowerPoints out there from all the operators that want to raise money, huh?
Yeah. So I found that it's just a different skill set to really, be an investor. You have to, so for me, number one thing I learned was trust my gut. There were some times that I went against my gut and I got burned. And the reason is that once you've seen enough patterns of doing stuff, you kind of start seeing like, okay, if a business is trying to do this and it kind of looks like this, there's a good chance it'll be successful. But if it kind of looks like this, probably not going to be successful. And you just start seeing patterns, right? The more you see this, the more you do this. And what I realized in the early days is I need to trust my gut. That was thing number one, because I went against my gut a couple of times and I got burned. So that was not good. Number two is, you'll hear everybody saying this, but it is the truth, is you're betting on the people. When we invested, for example, in the social media company I just said, the digital media company, it was such a nascent business that we kept saying, like, how do the unit economics work? I just don't know how they're going to work because they're all upside down right now. They're negative. So the more you scale a negative business, the worse the problem gets. But what we knew is that in combination with a super, super smart and very, very energetic founder, plus us helping, that we're going to find a way. And so we really were betting on the team and the founder, and you'll hear that over and over again, but that's the absolute truth. And then I think the last thing I'll tell you is, some folks want to kind of hang on forever on a deal. We learn real quick, don't be greedy. If there's an opportunity to create liquidity or an exit or a merge to basically create more value, meaning more infrastructure, more structure, take it, because you just never know where the world's going to go. And we've seen this with this pandemic, and we've seen it 10 years ago with the last downturn and so on. There's just so much unpredictability about the world.
Yeah, that's interesting. Who is it? Bessemer. I think, is it Bessemer that puts out their anti-portfolio, which is all the companies they could have invested in and they passed on. They do it as a little bit of humility. What I've never seen, but that you bring up a good point, is someone published, like, here's all the times I should have taken an exit and we didn't. We held on. And so there's certainly a kind of a handful of those that we know about. So question just popped in about so let's think about it from a RezVen perspective. So did you guys think about how much, how would the model or the economics of how much you were going to invest, how did you kind of decide that? What, in terms of deal size and investment size, was there a model that you followed or maybe still follow at RezVen?
Yeah, in terms of so we're a lot more flexible now. In the early days, I was trying to get a certain percentage ownership, because what I would just mathematically compute is, if I get this happens and then there's dilution and we do follow-ons and so on and so forth, you just have to kind of back into what a potential return would be, having fiduciary responsibility to our LPs, right? So you kind of figure out that math. And so I would do that. What I realize is, obviously the world is not that predictable. I tried to be too much of a quant. And so what we now look at is more around, how much capital is necessary, what's the milestone that it's going to take us to, and then are we comfortable, doing that and leaving a reserve, and so we really less focused on the percentage ownership, and we're more focused on success. And what is it going to take to get this thing to success? Is it $1 million investment, or is it a $100 million investment? And based on that, how are we going to play in that, and who are we going to bring to bear to help us with that?
Yeah, no, that's an interesting take, because not all investors have separated themselves from that model. Sometimes it's pretty clean. It's like we look at this and we need to wrap our heads around $100 million exit. So start with $100 million exit and then work backwards with round size, dilution, ownership stake, valuation, et cetera, all the way back. So if I'm hearing you right, I think it's a little bit more kind of stripped down. So where's a milestone? What's it going to take us to get to that successful milestone, and invest from there and grow from there?
100%. And then we know that the value add that we have is helping and accelerating and opening doors and doing those things. And so, we try as much as we can quantitatively to address that in our models, but it's hard to predict the future.
Right. Okay, so you started RezVen. You gathered these experts. You're making kind of one-off investments. You're making investments. You're adding your operational expertise. But then you decided to kick it up yet another level with C, right? So why don't you describe what you guys are doing, come from a model perspective? What are you doing at C? How's it different? And then let's kind of dig into that one for a while.
Okay, so the model with RezVen was always about advising as well as investing. It was those two go hand in hand together, not to be passive. What I missed about just kind of startups when I was investing is that I couldn't be as hands-on as I wanted to. And I really knew that the value add that I could bring and others could bring is just making sure that we navigate some of the pitfalls and the issues that a lot of folks encounter, first-time entrepreneurs encounter. And so the idea with C was almost to create kind of a new venture capital model, which is bring to bear all the smart people that we had, and then and so those are all subject matter experts, people who founded and sold companies in various different verticals, and bring to bear infrastructure. So that would be our core team is pretty large, and to bring to bear core infrastructure, and then bring to bear capital partners, and essentially create an environment where we could seed ideas, we could test ideas, and in a very hands-on way, figure out if there's signal, and if there's signal, scale the heck out of that. If there's not, don't get too in love with whatever it is that we're building. Figure out if there's a signal, be very scientific about it, and then shelve it. So, I mean, we've shelved plenty of things that just didn't, they looked like a great idea on paper, but then in practice just didn't materialize. So the idea was not to be just a board guy who sits there and is an investor, but really to be hands-on. And for those who know, we're super, super hands-on with every business that we're building to make sure that that we get as much acceleration as possible into the market.
Okay. So that's, I think you and I discussed that as kind of the C methodology, right? So you've actually kind of given it a name and a structure. So everyone involved in C kind of understands that methodology, and you follow it for all of your projects?
Yeah. So we have a chart that we talk about, and it's kind of the 0 to 1. And so it's every step of the way, what do you do? And now I won't be so bold as to say that everything falls in this very templated kind of format as much as we want it to.
Yeah.
But as we follow our guidelines, what we find is that very rapidly we are able to get to signal or non-signal. And then, every step of the way, we're making some type of progress towards ultimately creating a going concern or shelving it. And so, the way that we think about it, maybe this is from my scientific days of being a researcher, what do you do? Let's say, day 0, day 1, day 2, day 3, and we really try to figure out where should we be relative to our plan, and how come we're not there? And a lot of times it doesn't fall exactly on that curve, but we get pretty close. And the idea is to figure out, is it worth pursuing whatever we're doing? And if it is, we should have signal in a certain way. And if it isn't, it's fine. We learn something, we shelve it, we move on.
Okay. So you do that for projects that I imagine projects that you guys come up with internally.
Yes, correct.
You probably do that for when you have strategic relationships and you get some ideas kind of seeded to you from your strategic relationships. But now you'll look at an external idea, right? Someone comes to you, or someone comes to C with an idea that works. You'll work that with them. So if you don't mind, how might that deal work? What would it look like to the founder that brings something to C to kind of roll into your digital lab? What would that look like for the founders in the original team?
Yeah, so and we've done that many times. So it's either internally generated ideas, and then we just kind of run, or like you're saying, we partner with folks. The folks that typically come to us have not just an idea, because we just see so many ideas, but it's more about having some start of something, a little bit of traction, maybe a little bit of signal. It doesn't have to be perfect, but just something where it's like, there's something there. Second thing is they have some type of subject matter expertise in their field, right? So that's important, right? Because we all are trying to learn a new field together. So if we have someone who's been in the industry for a while, that's a lot more helpful than all of us just sitting around trying to figure out the industry. And what typically happens is we'll assess the market, we'll assess the sector that they're in, the industry that they're in, kind of like an investor would, right? Really looking at, is there there? Is this worth going after? Is this worth pursuing? Talking to them, because we're going to become business partners with them over the course of time, right? We're going to work very closely together. So do we have that, chemistry and that connection? And are we going to go out and kind of charge the world and get at it? And then we also look to see, what the mission and the vision is. Like there's a lot of things that are really cool products and technologies, but it may not necessarily be just the thing that we want to participate in. Once we get there, and we feel good about it, then essentially we'll figure out, how to partner. And partner really is, here's the stuff that I have, here's the stuff that you need, right? So you need maybe some, some help with engineering or some whatever it may be. We'll figure out kind of that responsibility slash, a functional area matrix. And then based on that, we'll say, okay, here's how we're going to partner together. This is the value we're going to bring to you. Here's the value you're going to bring to us, and away we go. Typically it takes us, oh gosh, it may take us several months, maybe more, to really dive in, make sure that the company's kind of where it needs to be. I call it making it investment grade. Most of the things that come to us are not investment grade. VCs wouldn't touch them for a lot of reasons. And so what we do is we basically get it ready, we get it investment grade, put team on it, shore up technology or whatever else we need to do, then ultimately raise some capital, and then we're off to the races. So that's kind of a quick high level of how the process works.
All right, I'm sorry to kind of keep scratching at it a little bit more. What would the cap table look like in that case? How is that, for an early stage company that's already founded that comes to you and you guys decide to bring it in to see, what does a cap table end up looking like?
Yeah, so we would join the cap table, and all those are just kind of like on a case by case basis, right? It depends on how early or late the concept is. Does it have traction? No, and so on. So it's a complex conversation, but nonetheless, we would join the cap table and then basically become partners with those folks.
Got it. Okay, so in each case each case is different. So you'll kind of look at it, and then what makes sense for the founders, what makes sense for C, to put it all together to get it to that investment grade that you spoke of. So and we typically only do things where we can add value, right? So it's not something where I'm not looking for deals to do. I'm looking at things where we can add a lot of value and help, and that's really the ones that we get excited by and we get behind. Good point. Okay, and you recently, literally between the time you and I talked a couple of days ago, getting ready for this, and today, there have actually been a couple of announcements, but there was an announcement that one of your companies raised $5 million. Is that right? Mm-hmm.
Yeah, Longev. So it's a company we started last year with this friend of ours, Doug, who's an expert in the industry that we went into. Longev is producing a whole host of plant-based products. And so the products are shelf-stable, very clean label, minimally processed. We did a huge amount of analysis, that C methodology I was talking about, and we figured out that there was a certain area of this industry that's already a relatively crowded industry, but that's a white space. Excuse me. And so once we identified that, we then figured out, okay, what are some of the products? What are some of the things that we could do to address that market? So we did that in about a year ago, tested it. So this is, our process. We tested it, make sure there's some legs to it. Ultimately fully launched 3 products in March of last year, and we continued to test it. So that was DTC. So Amazon and O&O. As soon as we did that, we started getting tons of inbound from retail, from food service, and so on. So we didn't even have a sales team, but without a sales team, we ended up getting into Erewhon, HEB, a ton of retail because they asked for it, and then ultimately a ton of food service. And so the company, without much of anything and no investment, the investment money just came in, scaled pretty significantly well on its own. And then we got to a point where we had to say, hey, we got to bring in some external partners to help us because it's scaling very fast. So that was brand new information this week.
And listen, great story, great success, and honestly, not one that I would have expected for C, right? I think I at least from my perspective think of you guys more on the software technology or in some cases kind of hardware technology side of things. I would not have thought about an plant-based food products. So that I think shows kind of some of the breadth of the opportunities you guys are looking at.
You would be right in your assessment. So the thing that's interesting about that is my senior team is unbelievably accomplished. So we always look to see where we can help, and then we look at who we partner with. And in the case of Longev, one of my guys ran new business at Pepsi. He's done a ton of CPG, 3 startups that he founded and sold. And so he's spearheading this. And then another one of my guys knows branding and marketing, but also helped relaunch a ton of products at Nestle. And so, so it turns out now I don't have the expertise personally, but we have that expertise on the team. And so we combined, our efforts together to kind of make this a success.
Okay. Listen, I'm going to go ahead and grab some questions that we have coming in here so we can kind of knock them off, and I'll try to kind of incorporate in what we're doing here. So what are some of the things that you've learned about getting team member buy-in in terms of equity and salary? So how important, I guess, I'm going to kind of modify the question, how important is the equity piece for the companies that you guys are working with in getting those team members motivated from an equity perspective?
Let me make sure I understand. Meaning, if we hire someone into one of these companies, what that package is? Or
yeah, when you have a startup, when one of the startups that you're kind of building up, it has its own team members. How important is equity compensation compared to the other aspects of it? What's important for you guys and for them?
I think it's case by case on the individual. Some people are cash flow motivated because they need to pay their bills. Other people have the long game in mind, so that would be equity. And so what we have is a comp structure where, depending on what the person chooses, more cash, more equity, the sliding scale, they kind of go up and down, inversely proportional to each other. And so we understand that everybody's got individual needs. So I can't prescribe anything for them, but what I can say is, here's what I can offer you. And so we feel the equity is definitely the thing that we're working for, right? We're in the long game. Everything that we do is a long game. And so we feel that the equity is extreme value. But we know that some folks, have to kind of prioritize. I think the equity is also a way for folks to get rewarded for all the hard work that they, put forth, and the reward and the results, kind of speak for themselves for a lot of these companies. And so I think a lot of people are excited to get equity. And we're excited to have everyone participate in that equity.
Yeah. Okay. Interesting that you do take that flexible approach. I commend you on that. So, in some firms, some companies that I've seen, startups, it might be more based on kind of job title and job kind of hierarchy on what they're getting. And I'll just make it up, every senior engineer gets 10,000 options or something like that. And,
right.
And it sounds like what you guys are doing, a little bit more nuanced to the individuals. So that's great. I commend you for that.
We banned everything by level. And then after that, we just allow flexibility. Yeah.
Okay, cool. Alec wants to know kind of what's some of the common mistakes you see on the early stage founders that come to you guys, and what are the areas that you guys kind of find they need the most support? So after you look at them, what's more common that you guys say, this is what they need?
Oh, gosh. I have so much to say.
Take your time. Don't take all the time, but take your time.
I think a lot of even just me, like when I have been through this process for the first time, I think the biggest challenge that founders have is I think two things that kind of play off each other. One is you fall in love with your idea to the point where you kind of ignore signals of what's happening in the market, and that's not good. And then the second thing is, I think sometimes you don't know what you don't know because you've never seen it before. And so I remember one particular company, I had a long debate with the CEO about the head of sales. And I was like, look, you got to hire the most amazing head of sales possible. And he's like, why? That guy's too senior. And I said, there's no such thing as too senior. That's going to take the burden off of you. And you could go and kind of focus on whatever you need to do. Right. And I think what was happening there in that interplay there is that I think he was a little bit afraid of letting go of the baby, like it's his baby. Yeah. Because he was a little scared of letting it go. But it's one of those things where once you've seen it once or twice, I bet you he would go out the next time around and hire the absolute most senior person possible to reduce the risk on the company, to reduce the burden on him, and ultimately get success. We in our discussions prevailed to kind of share our point of view and impress that upon him. And so he ended up hiring this amazing sales guy, and he killed it. But I think the big challenge, I think, for entrepreneurs, and from what we've seen is, I think it's just knowing what you don't know and really identifying that, being nimble. Don't fall in love with what it is that you've created. Try to evolve that into what it's ultimately destined to become. And I also feel like a lot of the stuff around like corporate governance and fundraising and like some of the back office stuff is like a mystery to most founders. They don't understand like, hey, what does a board meeting look like and so on. But when you get investors to join your board, they expect that you know. Yeah. And so it's a lot of that kind of maturation that needs to happen, that maturity that needs to come to play. I find that most of our founders are extremely, extremely good at their industry, product strategy. They really know what they're trying to build. It's just the rest of it that to kind of build a well-rounded business that sometimes is not all there.
Okay, cool.
That's the area we help. That's the stuff that we bring.
Yeah, I quickly jotted down, and so I like to kind of at least what I caught there is that make sure that the founders are looking at the signals. So in other words, be open to the data that you're hearing from the marketplace or from the technology.
Yes.
Don't be afraid of hiring experts. That's one there. Be ready to evolve. And I think that's important, that some, kind of your group can bring to this, because I think, you're going to be successful when you're looking at the very big picture and where can this go? And sometime evolving to that point might be a stretch for some of these founders. So just some good points that I wrote down. There's a couple of questions in here that have to do a little bit more on the model and kind of a compare and contrast. So somebody wants to know, well, if you were to compare and contrast what you guys are doing at C with the typical Y Combinator model, how would that be different from what they're offering?
They offer a lot of tools and a lot of structure. We are hands-on. Like, my team co-runs these businesses. So it's not like we're just saying, hey, go do the stuff. We are on the board of every single company. I have weekly meetings with every CEO. We have touch bases, operational touch bases every week with every company, and the senior folks get involved. So there's a lot of hands-on experience that's basically being pushed into these companies. By virtue of what we do, I can't have 100 companies in my portfolio. It just doesn't work. Yeah. And so we are very selective about what we pick and choose, because we want to bet on the things that we think we can be extremely successful at. But I think the difference is that you're getting a business partner, someone to sit side by side with you who's done this many, many times. And essentially we work together to try to figure out what there is. Y Combinator, 500 Startups, a lot of those have fantastic programs, but they're really focused on scale. And so for us, we're less focused on trying to get to 1,000 startups, and we're more focused on picking really, really good ones that we can bet on and create really quick returns and really quick outcomes and successes.
Good point. So they're interested in scaling on their own side of things. So, all right. Well, let's tell us a couple more questions about C. Does a company ever leave C before an acquisition? I guess that's so. When do they, quote, leave the nest, leave the C prior to acquisition?
Yeah, typically what we do is, from wherever the starting point is, whether it's just a nascent idea or there's some kind of a rolling start, so wherever that is, to kind of like post Series A, they're with us and we're pretty close to them. Post Series A, they start kind of doing their thing. They're still part of the family. We're still very actively involved. But at that point, like one of our companies that we moved to LA, that business post Series A, before Series B, had a $22 million Series B. And it was just too big at that point. Like, it's completely self-contained. It has all the executives it needs, is all the staff it needs. And then now we're just more advising and adjusting things at the board level versus being hands-on. It's extremely critical in the early days to be hands-on. And so we keep those companies really close to us until post Series A.
Okay. So we talked about Longev. Do you want to tell us about another company that you guys are working at C? Maybe Performa, ASAP, or Titan, or one of those? One of the ones I can see behind you there on your side.
Yeah. Which one can I tell you about? ASAP was kind of interesting. So ASAP Tire was a business that literally was a last mile solution and a logistics business for the tire industry. And again, when you think about it, you sit around and you say, okay, what's one of the worst things about owning a car? And most people say, well, I don't want to pay payments and insurance and gas. And, but we kind of looked at it and said, okay, what's one of the biggest time sucks? And it doesn't happen often, but you have to get new tires on your car from time to time. And so that entire experience is unbelievably terrible for most folks. It takes 3 hours by the time you go to the store, get your tires changed, come back. Our thesis was really simple. Our thesis was, can we take an antiquated market like tire replacement and essentially modernize it? So can you schedule online, order online, and have it come to you versus you going to it? And that was a question we asked. And so we did our C methodology. We figured out all sorts of information about market, partners, all sorts of stuff, and then we went at it. The company was scaled. So we raised capital. The company was scaled and sold in about 18 months. And what we realized was in that short period of time, and then we had a lot of suitors. We had a lot of big companies. Ultimately, the company that bought it was Tire Rack, and Tire Rack is the largest seller of tires online. What we realized very quickly is that we had solved the last mile for a company like Tire Rack, a company like Amazon, eBay. A lot of folks, if you buy this product online, the problem with it is you can't install it yourself. And so what we had done is essentially brought a solution where you could now buy it and then you can install it. You completely avoid the tire stores. And so as we went through our methodology, we realized the industry is huge. Consumers desperately want this. And why? They're willing to pay a premium because we're giving them time back. And anytime you can make time for someone, then they're willing to pay. Most people are willing to pay for that because it's a convenience. And I think in normal situations that, we would have said, what the heck? We're getting into, buying Sprinter vans and putting stuff in there. But we went after it. And actually, for a period of time, we're one of the largest Sprinter van buyers or purchasers in the US, which is kind of crazy. But then what we saw really quickly after we scaled the business is that there was a ton of suitors. Bridgestone, Tire Rack, Amazon, eBay, lots of them, Goodyear came out to us and said, hey, we were trying to do this stuff on our own. We just don't know how to do it. What did you guys do? And what we did is we combined logistics, and we had some amazing logistics Smarties Pants people with a lot of cool technology. And then we merged those two things together, and it became what became ASAP Tire. So an example of using our C methodology, solving a real problem. Consumers really hated going to those stores, and then giving them value very quickly.
And that was exited or?
Yeah, about 2 years ago now.
Okay. Oh, terrific. Okay. No, that's right. You said Tire Rack, so I apologize for that. Yeah. So let's kind of move on a little bit. I think we're getting here into our time. So let's get on to some other, I think, interesting parts of kind of you and your background and what you can share. So you also spent some time on public boards. Is that right?
Recently public boards. You talking about Petco?
Yeah.
Petco's been interesting. Petco's been public, private, public. It's kind of gone all over the place. It just went public again yesterday.
I saw that. Yeah, you've had a lot of transactions this week, dude.
So yeah. That I won't take credit for that, but what I'll tell you is the thing that was interesting about Petco, and let's call it a big company board. Our startup board's extremely nimble. We're meeting like once a month, if not more often, talking about things and doing stuff. And our decks are in 10 or 12 pages long, and we're going things. I remember the first Petco board meeting I went to. I got a binder, I swear to you, like 2 inches thick. There was probably 300 pages printed in there. And I was like, holy smokes, how are we going to go through this? And those board meetings are all day and extremely intense. But what the corporate thing has taught me is it really gives me an appreciation, because a lot of times we're trying to disrupt the corporates or the big companies that don't know what they're doing kind of thing, right? But it gives me an appreciation for how much they try to keep the ship going forward, making sure that they're protecting, Petco's revenues are 4 billion or so, 4.5 billion. You got to protect that. You can't just start willy-nilly doing things. And it gave me a lot of appreciation for why innovation dies inside of those companies, because everybody's focused on a P&L, everyone's focused on execution, and startups really can't exist in there. So they have to exist somewhere else where people can take the risk. There is no P&L responsibility. And then when the time's right, you can kind of scoop it up and put it in here. But it's amazing how much more nimble our startup boards are relative to the big company board, but it's been an unbelievably cool experience for me to kind of see both.
Okay, no, that's great, and gives you kind of both insight into that, which is what your startups want to do and disrupt some of those things. So that's 100%. Terrific. So hopefully Petco's aware that you're learning the whole time and adding value in other places. So
I'm learning all the time, and I'm helping them learn all the time. So it's
exactly. All right, so let's we're start of a new year here. It's it hopefully is not going to be like 2020, but what are some of the sectors that you're excited about? So as you think about 2021, are there sectors or business models that you think are going to be very interesting in 2021?
We spend a lot of time thinking about that. I think there's some of the oldies but goodies, and then there's some kind of new things. For me, like oldies but goodies, I think any kind of data play, I love like fintech, anything like data play, anything that's got massive scale. And so we have actually a pretty interesting group of folks that are working on GovTech, believe it or not. And so the Muni tech, like Titan was one of them. And then we've got, Performa, and there's others. And so, so the idea is, we're selling product to government or municipal institutions, which are like unbelievably difficult to get into, and they're very slow. But then once you're in there and you're solving a real problem, it's pretty fantastic to see the results. The thing that we've been now looking at is saying, okay, this coronavirus thing has really caused a lot of disruption for retailers. It's caused a lot of disruption for restaurants, just people in general. And so we've been spending quite a bit of time reimagining what kind of the new world will be after, or during coronavirus, right? So what's the city of the future look like? What does the office of the future look like? What does work and collaboration of the future looks like? And some of those things are born by or drawn from our own experiences, where we can no longer whiteboard things together because we've been remote for almost a year now. And so it's trying to figure out how to create the same productivity, have the same effects, have the same engagement with consumers, whatever it may be, but to do it in this new world. And so that's a whole entire area that we've been focused on. And then last thing is, like robotics and AI, like we've been spending a lot of time just kind of investigating and seeing if there's a there for us.
Okay. Hey, one quick follow-up to that. Can you tell everyone that's not familiar what fintech is? I think you use that one. That's probably the one that's most might be most obscure. So call fintech, or what is fintech?
Oh, fintech, financial.
Fintech. No wonder I didn't get it. Fintech.
Yeah,
Got it. I think you said that. You like threw me for one there. So fintech, of course.
Sorry.
Okay, good. So two follow-up questions to that, or additional follow-up questions is this you said we're getting together, we're thinking about the office of the future and retail of the future, cities of the future, et cetera. Is that a structured activity that you're doing at C, or so do you get together and strategically think about those things?
Yes, we do. We do strategically think about those things. Let's talk about the city of the future. We are actually, we'll talk about this soon, but we're actually partnered with a pretty well-known, significant city, and we're working together with them to figure out, basically civic tech, but also what does the city of the future look like? What happens when people, they don't come to offices anymore. They buy a little bit bigger home so they can work out of the home. What happens when they leave the city and they're just not, what's the incentive or the impetus for them to come back? And so, we actively think about these things, and then we say, okay, that's good. We can't just sit in a room and think about it on our own. Then we find partners and folks that we can work with to ultimately help accelerate that.
Okay. And do you think then in 2021, will this spur some internal companies that you'll generate, or kind of external companies that you'll try to find and bring in?
The hope, well, it could be either. I think first we got to figure out the thesis, and we haven't figured that out yet. And then we can see, based on the thesis, what might fit. It might be an external company, or it might be an internal idea that's generated, but we're actively investigating a lot of the things that I just said.
Okay. Hey, for those of you that have kind of typed questions into the Q&A box, some of them are pretty specific, probably like specific to you asking that. So if you don't mind, I'm going to hold off on some of those that are specific, and Andre and I will go in afterwards, and we'll grab some of those. So I'm not ignoring you. I'm just kind of deferring it to kind of stick to things that maybe our whole audience will like. So I appreciate your patience. So you've also, you went to high school in Huntington Beach, USC, UCLA. Pasadena with Overture. You've been in the Southern California ecosystem for quite a long time. So can you speak to the Southern California ecosystem a little bit in terms of either what's changed, what direction would you like to see it go? Where should, for the folks that are thinking about the ecosystem and the direction it needs to move, what should they focus on?
I mean, it's changed so much since 20 years ago. Back then there was little pockets of technology. There was, Overture came out of Idea Lab. So, Bill Gross has created, 155 companies or something. I mean, he's an amazing guy, super smart. So there was that whole kind of Caltech corridor, Pasadena corridor, that's produced so many amazing things. Then there was kind of the West Side corridor, not really much going on downtown, and Orange County was really focused on more like medical device and that kind of stuff. This was like many, many years ago.
Yeah.
Now what we're seeing is everything's kind of evolved, as we've seen exits, as we've seen people kind of recycle their capital and their know-how, and they're doing new things. it just seems like startups are more ubiquitous, right? Which is great. I think the challenge we have here still relative to the Bay Area is just concentration. We're so spread out. It's hard to have like one or two focal points or concentrations of people. So I know UCI's done a fantastic job, with the Cove and applied innovation and all the stuff that's going on there. It's done a fantastic job. So it's a nice hub here locally. But I would bet you a lot of folks don't necessarily kind of go back and forth to Pasadena where there's stuff going on there. And then there's a little hub in downtown, and then there's a hub in Playa and Santa Monica and so on. My wish, which will never come true, is how do you shrink that down a little bit so that there could be even deeper collaboration? Because a lot of times when we would host events in our office in Irvine, we wouldn't get the LA people. They just didn't want to come down. It's too far. And then we would host people in our LA office. Then the people from Orange County didn't want to come up. And so I guess maybe this kind of Zoom, kind of structure that we have will do it. But it's been really, really, I think, difficult to break the actual geographic barriers. But other than that, I think there's so much desire to do. And for a lot of folks who are coming back home, people that went to the Bay Area and now there's a mass exodus coming back to Southern California, LA, Orange County. It's really nice to get the brain power and to get the resources and the connections to come here and kind of start the next thing. So I like where we're going. I love these pockets. I just wish it was easier to navigate those pockets.
Yeah, I think it's going to be really fascinating to see, which I believe is the how will the hybrid model evolve? I think we're all craving to get back to in-person networking, in-person meetings because of the serendipity that happens. You're just, you never know who you're going to run into and what conversation you're going to have. We're missing out on that a little bit. But the flip side is we've got so much more reach now. I think, if this webinar were being held at the Cove for lunch on a Friday, we probably wouldn't have 3/4 of the people. There'd be different people, but maybe 3/4 of the people that are on the webinar right now wouldn't be able to make it down to the Cove for lunch. Right. So, my expectation is that it's going to merge somewhere in the middle. So what that model looks like, I think, is going to be fascinating to see. But you're right. We need to continue to make sure we're building on the best aspects of both of them. So, Scott asked an interesting question on here. This maybe applies to everybody. It says, new founders often get mountains of contradictory advice. So how do you kind of putting yourself in the mindset of a founder that is hearing one thing and then kind of hears the opposite thing? How do you bring those things together when you're hearing kind of very different things? And from advisors, maybe how do your founders react when you give them contradictory advice to what they've been doing?
I would say consider the source. I think everybody's got an opinion, but you have to figure out where that opinion is generating, where is it coming from? And so I have a lot of opinions on a lot of things, but let's say with Longev, there's a lot I don't know about bringing CPG to market. My team does. So I defer to them and I listen to them. I think in areas where I'm an expert, then, where I've had a lot of experience, what I typically do is I typically share with and give from my experience and say, look, in this situation, this is what happened. This is what I think you should do. So it's not necessarily, a feeling. It's not necessarily, I think we got to do this. It's more, let me show you some data points of what and we've done this so many times now, and the team has, that it's very simple for us to share from our experiences what's worked and what hasn't worked. Doesn't mean it's always correct. But what we do is, I would say, my answer would be consider the source and who's giving that to you. If your lawyer's telling you to do something in a certain way for legal purposes, probably listen to that guy. If it's your dentist, probably shouldn't listen to that guy. And the thing is, early stage, everybody's got an opinion on what you should do and don't do.
Yeah. So consider the source and consider the data, or if you can, do some test and read the data, read the signal, as you like to say, and then see what kind of happens there. Correct. So how patient are you? How patient should founders be, kind of early investors on kind of time to market? What in today's world, how much product development stage for, we're going to have to pick one. So let's just pick a software product. So if you got a software product going to consumers, or maybe a software product going to enterprise, how patient are you, or should founders maybe be with themselves on product development and kind of getting to customer one?
Customer one is extremely important because, that's the start of your product market fit. So you've got a product, and that's the market. Especially if customer one pays, that's definitely locks in your. So I think being patient is extremely important. Everything that we've done, we like to have unfair advantages. We don't just kind of do things and hope it works. And so in every product that we put out there, we typically already have customers lined up, and we might even be co-building it with them so that we know we're going to have a customer.
Okay.
So that's like with Performa, for example. We've been building this. The Performa is a neurocognitive science-based training accelerator. And it's basically gamifying how people learn and doing it in a way where it's extremely sticky. And the results that we've gotten have been pretty fantastic. We tested it first in sports, and now what we've done is we pivoted it because we want to do good in the society. We pivoted it last year, actually even before last year, to focus on first responders. Specifically, it is a police training accelerator to teach them how to be better. And we could have never created that on our own because there's too much guessing. And so what we did is we went and created it with our first customer. And as a result, the product's already in a very short period of time in market, tested, alpha test, beta test, so on and so forth. Much easier to do it that way because I'm getting real-time feedback on the product.
Good. Well, that's great advice. So listen, our time's pretty much up. So anything else you'd like to add that we haven't really touched on?
I think we touched on a lot of stuff. I am excited about what you guys are doing at Applied Innovation, Cove, UCI. You guys are just right down the street from us, which is amazing. I appreciate you having me to talk a little bit about what we do and kind of share a little bit of a glimpse behind the curtain.
Well, listen, it's been our pleasure, and thank you so much for joining us. So as I mentioned before, we've got quite a few of those of you that have written questions in the Q&A box. Anderee and I will hang out a little bit and we'll answer those. So kind of keep your Q&A box open and you'll see the answers to that. So otherwise, though, I think I want to start just wrapping it up here and making sure that we thank our VC Speaker Series sponsor, Kenobi Martins, where you'll find a unique intersection of technical intelligence and legal acumen for a world powered by innovation. And you can see Anderee's LinkedIn on there. He was generous enough to share that with us. So if you want to reach out to him there. And then you can see my contact information down at the bottom. And we've moved to a monthly, our URL still says weekly webinars on there, but we've moved to a monthly cadence for this. So watch your emails for announcements for our next webinar, which will be sometime in February. But other than that, Anderee, thank you so much for participating and sharing what your experience has been at RezVen and C. And to everyone else out there, thank you so much. Stay safe and have a great weekend. Bye-bye.
Thank you, everyone.